So today we're going to talk about just pretty quickly, what is revenue-based financing, how does it work, and a little bit about the Thrive Impact Fund. So Emmeline, can you go to the next slide, please? So this is what we're going to chat through, a quick overview of TIF. What is revenue-based financing? Who is it for? How does it work? How we are using Thrive Impact Fund, revenue-based financing tool. And then we'll open it up for questions and answers. So next slide. So first of all, we wanted to talk about why we founded Thrive Impact Fund. And so we at Scale have worked since 2014 together as a collective of nonprofit leaders and social enterprise leaders to help develop capacity within the nonprofit sector to build really strong revenue generating, enterprising approaches to change, and to think about how we can really resource impactful approaches to change. And we see that there's impact organizations, of what we are considering any organization that is designed, is in their DNA to meet a social, environmental, or cultural issue. And that there's many around BC that are doing amazing work, but are really struggling to find the resources to grow and to scale the work that they're doing. So we thought there's a really big opportunity to not only find a way to meet that capital gap and to be able to address the needs that impact organizations are needing in order to, grow the initiatives that they're doing, to grow their revenue generation opportunities, but also to connect investors to local projects. So this is how we developed the Thrive Impact Fund. Next slide, please. So Thrive Impact Fund is a BC-based impact fund. We are providing investors an opportunity to capitalize the sector, and we're really focused on impact first with a steady financial return for investors. Next slide, please. And this is a summary of it. So like I mentioned, it's a financial, it is a financial and impact returns. And again, the kind of organizations we're looking to invest in are ones that put impact at the core of the work that they're doing. We are, I'm going to say, incorporation agnostic. Nonprofits, charities, cooperatives, and for-profit social enterprises are who we are going to invest in. And we provide patient and flexible debt financing. So this is one of the ways that we're looking. As we tried to look at, and Emmeline will talk about this very shortly, we tried to look at how we can make debt act like equity, because nonprofits and charities can't take equity, and co-ops it's difficult as well. And so we really wanted to create a fund that allowed that flexibility and patient capital, but in a way that any organization, regardless of your incorporation, could access that kind of capital to grow. So, and then we provide capacity building and community supports around our investees to help them succeed. We're really deeply community focused, and we're really looking at how we use our type of investment to also look at co-investments and ways to remove barriers to traditional financing that may exist. We call this Catalytic Cap Capital. We look at early revenue stage projects, so not startup, but early stage. We provide flexible patient loans and revenue-based financing, which is what we're going to talk about. And we'll talk about this more in our next session as well, around what this means in terms of providing equity-like debt and how it works. And then we do that wraparound support. And we really believe at matching the right capital to a project at the right time. And Emmeline is going to talk a bit about how she sort of does this magic of really looking at what is the best kind of capital to bring towards to make projects succeed. And so we do offer 3 different types of financing. One's an early revenue loan for early stage and not startup, because you have to demonstrate a revenue stream and have a proof of concept. So that's our early stage. We have flexible term loan, and then we provide revenue-based financing, which is up to 7 years. So I'm going to pass it over to Emmeline, who's going to talk broadly about revenue-based financing and then specifically about what we offer. But we really want to dig into this really incredible tool that we're advancing in Canada.
Thank you, Christy. So today we're going to talk about REF, revenue-based financing, who is also called royalty financing. And this with history, it's a financing scheme that has been historically used in industries with high upfront cost and potentially very long-term gains. You may be familiar with it because it's very popular in the field of movie industry, publishing, but also mining and pharmaceutics. Today, it is widely used in the US and in Latin America as a way to finance growth projects of mature organizations by repaying the investor with a piece of revenue instead of a fixed principal and interest payment in the case of traditional debt, but as well instead of dividend and exit in the case of equity. Some RBF deals are also called profit share. You may have heard this term, where the repayment is based on a piece of profit instead of revenue. It is a pay-as-you-grow model where investors and investees share the risk through a medium long-term partnership. It means that if things go well, the investor is repaid as the model was built, but also that if it goes better, the repayment is faster. And if things go slower, the repayment will be achieved in a longer time frame. It is a very flexible tool by nature. You can see here a capital continuum showing the different type of financing available on the market for organizations that are looking to grow. It is spread on the traditional metrics of risk reward. We could add a third dimension of impact for our sector. On the left, funding and traditional debt, where the risk is low, but the return to investors tends to be low as well. And on the right, there is equity, where the risk is higher, but the expected return is generally a double or triple digit figure. RBF sits in the middle of the continuum and belongs to the flexible debt category, provided generally by institutions that are less regulated than banks or credit unions. What these institutions can do is tailor loans that are just to the needs of the investee and offer customized terms regarding duration, grace periods, or collateral requirements. These products are generally future-focused, based on future cash flow like equity, especially in the case of RBF. And we will explain how it works a little bit later. They are more risk tolerant and work really well for medium growth enterprises that have some risk, which is the profile of most of the businesses and social enterprises being moderately risky and promising moderate financial return. RBF and other equity-like debt tools come here to fill a gap for organizations that are ready to grow, can demonstrate solid track record and proven business model, but may struggle to access traditional debt due to the lack of collateral or personal guarantee, and will not be able, on the other hand, to offer the growth rates or margins that are attractive enough for equity investors. In the case that they can even take equity, which is not the situation of community-owned impact organizations like charities and nonprofits. We could add as well that RBF preserves ownership for the entrepreneur compared to equity investments. While there is still guidance and advisory offered by the investor, the ownership remains to the entrepreneur. RBF comes with four main benefits for the investee. It offers flexible repayments made on revenue based on a predefined target return and term. The loan is collateralized with revenue and not an asset, which removes a huge barrier. With RBF, you're not locked into a fixed monthly payment. Essentially, your payment grows as your revenue grows, and you will repay within your capacity, more like in an equity mindset. RBF also self-liquidates. The product is calculated from the beginning to make sure principal and return are achieved at term. There is no need to plan for an exit, nor to refinance with another lender. And if the target is not achieved at term, the conditions may be renegotiated with a potential added return for the investor. It is a shared success model. RBF is a partnership for success. The investor has as much interest as the investee to see the business being successful, and the risk is shared. The investor will have to adapt if things go slower than expected. It is very different than traditional debt, where collateral and other sources of repayments are available. Here, the investor is closely associated to the success of the project. And finally, RBF investors are hands-on. It requires a close follow-up, meaning monthly or quarterly monitoring on sales to verify the projected revenue trajectory and adjust payments if needed. The lender can bring advisory capacity as a real partner, an active investor, without having proper ownership through shares, as we explained before. and the control is left to the entrepreneur with full decision-making authority. Who is it for? RBF is really well suited for businesses with proven business model, with existing solid revenue streams and good profit margins. It is crucial to make sure we can keep some revenue in the company and offer financial room for revenue as a repayment, while operations will still be covered and ideally generate a profit. It requires significant growth projections, at least 15% per year, to make sure the target return is achieved in a reasonable time frame. RBF implies a close monitoring on sales and calculation of repayments to the investor on a monthly or quarterly basis. You will need to secure the capacity in your team to provide the relevant information. Achieving growth targets relies on a strong management team and their willingness to benefit from advice from the investor and other stakeholders. And RBF can be used to finance any type of investments that would drive sales with an underlying asset or not, meaning it can finance hiring or marketing expenses, for example. A key element is to adjust the amount that is loaned to the current revenue to make sure we build a sustainable repayment profile. Altogether, you may have understood that RBF is not well suited for startup or steady performer. This profile will be best served or by venture equity or by traditional debt. The way we build an RBF repayment profile is to use future cash flow, revenue projections with the starting points in year one, the current revenue generated by the organizations, and then a growth trajectory that will be modeled in a pro forma with a stress scenario. The return targets, what we call the multiple, and the duration of the loan will come from an agreement between the investor and the investee after assessing the risk profile of the deal. Other factors can be taken into account, like the percentage of revenue paid to the investor and the total amount that is loaned regarding revenue. The deal will be built to ensure a sustainable repayment capacity while limiting the financial pressure on the investee and keep revenue in the company. Let's take a short example here. A nonprofit growing their social enterprise requiring financing for staff and marketing expenses, requesting a $200,000 loan. After due diligence, the investor and the investee will agree on a multiple target of 2, a piece of revenue paid of 5%. In the green column, you can see the revenue, and the orange parts are the piece of revenue that is used as repayment. Here, we modeled a starting point at $800,000, a 15% yearly growth, and it shows that the RBF loan is repaid within 6 years. If you overperform this scenario with the same financial criteria, still loaning $200K, return goal of 2x, starting revenue at $800K, and a piece of revenue of 5%, you can see here that with 25% yearly growth, the RBF is repaid 1 year earlier within 5 years. And in an optimistic scenario, 40% revenue growth, we end up having paid back the loan in 4 years, which is quite a short time frame for an RBF deal. What is interesting in these examples is that demonstrate that the faster you grow, the earlier the loan gets repaid, which is a win-win for both investee and investor. For the organization, it means the financing moves with you, adjusts to your growth rate, and for the investor, the capital comes back faster into the fund and becomes available again to be recycled and reinvested in community. As we explained at the beginning of this presentation, TIF financing offer takes the form of equity-like debt, and RBF is a key financing tool in our offer. It sits on the higher risk, higher return side of the offer, and has been created to support the growth of impact organization. Our philosophy for RBF is to use the tool as a flexible way to leverage growth for riskier projects without being too extractive and preserving the capacity of the organization to flow revenue. For those reasons, we've decided to cap a certain number of ratios in our RBF deals. Our multiple will be capped at 2. The launch revenue ratio should be kept under 25%. But also the revenue piece paid to an investor should sit between 3 to 5%. Under these terms, we ensure that the deal is a win-win to our sector. It's a way to preserve the investor capital, but also enable a sustainable growth for the organization, preserving margins and cash flow. And in our RBF offer, we won't ask for collateral. It's an unsecured loan, meaning the risk is completely shared. TIF also offers extra financial support to the investee in our loan offer. And this is our key risk mitigation strategy through coaching, consulting, and peer learning to work together towards success. Our first investment was made through an RBF into a growing social enterprise, offering economic opportunities for writers and artists on Salt Spring Island. I hope you enjoyed the presentation. We're going to move to a Q&A. We still have quite a good amount of time. But as a heads up, this is our first station of Social Finance Chat. And the next one will be in February on equity like that. You can register through our Eventbrite. And this is my contact information. The slides will be shared as well as the recording. Don't hesitate to get in touch. And we're happy to chat now and answer any questions. Feel free to turn the mic on and the camera, and we'll answer the questions in the chat.
Yeah, so if people want to, you can either put questions into the chat, or you can feel free to raise your hand and ask questions and so on. Emmeline, I have a first question. I'm wondering if you can talk a little bit more about when, actually, can we leave that up for just a bit? I think it's just in case people want to, it's okay, whatever. Yeah, I'm just wondering if you can talk a little bit about when you don't think an RBF deal works. Like, what are the signs of a project that might need more like a term loan versus a revenue-based financing?
It's all about future growth. RBF, as we have seen in examples, works really well with a significant growth profile. We've tailored it so it can suit quite a large array of growth rates, but it's really made for projects that would drive sales in a significant way. And whenever some collateral is available, it will also be more suited for a term loan with an asset-backed profile, which will as well decrease the pricing, because this is all about having risk-adjusted pricing in our loans. But this is something that we'll look into details whenever we have a case, and we'll tailor the right tool for you.
Chris, you have a question.
Well, yeah, hey, thanks, guys. Yeah, super exciting. Question around, it looked as though it was 25% of the current revenue. So a question on the kind of the traction you want to see. If you've got a good scale potential in front of you, there's that limiting factor of 25% based on your current revenue. So, and then in terms of revenue, is that earned revenue, or is there also, you know, what else can you include in that revenue?
So I'll answer the second part of the question, then pass over to Emmeline about that. So in terms of for revenue, when we look at an organization's profile and their financials, we exclude grants from the revenue piece, right? And so we're really looking at revenue that comes from contracts, that can come from growth, from sales, from fee for service, from social enterprise activity. And so that's the place that it's done on, just because many grants stipulate that you're not allowed to use grants to pay for debt and so on. So we want to make sure that we're clear with people's, you know, right, honoring the granting process, but also that isolating that revenue. Emmeline, you wanted to talk about, can you respond about 25%?
Absolutely. We have realized that the model is extremely sensitive to this specific ratio, even more than the growth rate or the percentage that is paid to the investor. And this is all about making sure that the financing will be sustainably repaid within a reasonable time frame. We can go up to 7 years already, but even within this time frame, if we go over the 25% ratio, most of the time it doesn't really work. It's all about, again, tailoring the right tool. So we may have exceptions, but we just found that it was a very productive measure to make sure it works for, again, both investor and investee.
Okay, cool. Yeah.
Yes, thank you, Chris. Can we move to the next question? Awesome, thank you. If you have more, Chris, just put it into the chat.
Thank you for your presentation. I had two questions. The first one is, are we able to reduce the multiple if the enterprise exhibits a very important growth, like more than the optimistic scenario? Because otherwise it would be costly to pay double the amount of capital within 3 years.
Absolutely. So 3 years, definitely paying 2 times in 3 years. This is not the model we've chosen for TIF. This exists on the market though. It's more like definitely an equity trajectory. We are flexible as well on the multiple. We've capped it at 2. It can be lower. I would say that it's more a risk profile. It's more about like how risky is the project, and we will adjust the multiple we're expecting, considering the risk that TIF is taking.
Okay, but it's fixed at the moment of the initial loan.
Absolutely. And the difference will be that if you grow faster, you will repay faster, as I've shown in like our very simple examples.
Okay, perfect. And the second question was about the frequency of payment.
It depends on the funds. Some funds do monthly payments. We've decided to do quarterly payments.
Quarter, okay. No, so based on the revenue of the previous quarter. So you
Absolutely.
need to follow up the financial statements.
Exactly. It's going to be a quarterly meeting on financial statements, and we're going to determine the piece of the line of revenue we are going to select. Sometimes we can exclude some costs, but that's again a very tailored approach. And we are going to determine what is the 5% of this amount of revenue paid quarterly.
Perfect. Thank you.
Meredith, you have a question.
Yeah, thank you. This is very exciting. I just wanted to learn a little bit more about what is Thrive Impact Fund's portfolio going to look like? Like how many investments are you guys trying to make in a certain time period? How much capital do you have like in total to be able to deploy?
So our goal is to have a $10 million fund, and we're raising capital over 3 years for that. And we will do between 10 and 15 projects a year. But it all depends on the amount of capital each project, like we've modeled it out at around that, but it really depends on who fits our profile, what the needs are of the sector, and being able to grow and target that way. Yeah.
Okay, great. Thank you very much.
All right, we have a question in the chat that says, for executive directors that need to talk to their board about this kind of financing, what kind of information would you recommend providing to a board on this? Emmeline, do you have any suggestions?
I think highlighting the fact that the model moves as you grow, and maybe showing different scenarios is a good way to approach it. Definitely that will require a little bit of financial engineering with me, but we could provide some models around that. Yeah.
So really financial modeling out about how it would work, and so that they can see, similar to what Emmeline did on that slide, how the growth trajectory is, what the goals are, and then the financing piece on top of it so that they can understand. Here we have a question from Timmy. If the investor revenues temporarily go down, is there a floor amount, i.e. 25% or a minimum? Timmy, I'm wondering if you wanted to unmute and say your question, just so that we make sure we understand it.
Oh yeah, like I'm just curious, like what if the revenues go down significantly, that maybe 25% of the revenues is just maybe too small for the investors if that ever happens? So is there a minimum amount of interest that they would have to at least reach?
No, it's definitely a flexible loan, meaning it's going to adapt to the trajectory. As we said, if the revenue goes down and the repayment is lower, it's a risk that is shared. Then it just means the 25% ratio is in year 1, in the starting point of revenue where we calculate the trajectory. And then it's all about making sure we have good assumptions on revenue growth. And that's why I mentioned the pro forma, and well, you may know all about that, and we're going to stress the assumptions, of course, to make sure we keep some margins and room, and that if a better scenario comes in, it's a win-win for everyone.
I see. Thank you so much.
You're welcome.
We have a fun question that is the fund focused geographically in BC or all our regions. So Scale Collaborative works primarily on the island and the coast. And so we do a lot of our work with organizations here. We're expanding to Okanagan and interior BC. And so there will be a more focus on providing investments and investments into that region. And then some of the organizations we've seen that we also work with in the Lower Mainland. So part of it is being able to make sure that we have an opportunity to have a relationship is a really key piece of Thrive Impact Fund, a relationship with us and our investees, a relationship between the community of investees. And so we really look for understanding your project, having relationship with you, having a trust-based relationship and so on. So that's why we really have started in one geography and beginning to sort of expand slowly as we go and have networks of support in different regions. So there we go. But really what we're looking for is are really good projects that are trying to make impact and are just falling in this, need this kind of capital to help grow with them and would benefit from the support of Scale and our partners. Any final questions? Emmeline, do you want to just go back one slide? So thank you so much for joining us. Feel free to reach out and ask any questions to Emmeline or myself. You can find us at the thriveimpactfund.ca website. We're putting together these quick snapshots, as you can see, 30 minutes of really quick to have conversations about these tools. Next time, we're really going to talk about how we make debt act like equity. What's the role of equity? What does it look like? Why is it important? And what do we do for this huge sector and organizations and for-profits that might not want to give up their ownership stake? How are we've thought about and really looking at ways to make it function and do the work of equity in that. So we're going to delve into that. And then we have a whole bunch of other series, including conversations around like fear of financing, you know, like why sometimes there's a fear of financing. What does that mean? Where does that come from? How do we overcome it? How do we look at non-extractive financing and be regenerative? So looking at ways that we use financing to grow, not to take. And so getting into some of the concepts around that. And many more. So feel free to hop onto our website to click on and join us for another 30 minutes of impact in a month.